Shall we start now? Okay, welcome to our IR4U webinar series number 3 for this year. So today's topic is implications of Trump 2.0. Well, judging from the market's recent performance, this must be the hottest topic in town for now. So let me just introduce our distinguished speaker. So our speaker for today is Julia Goh from UOB Malaysia. So Julia has been with UOB Malaysia since 2015. She has 12 years of experience in the research in the stockbroking industry. So currently she is responsible for the UOB Malaysia's global economics and market research team. So she is an award-winning analyst with award from. She has won the Best Sell-Side Research and Individuals at the Asset Benchmark Research Awards for 5 consecutive years since 2020. So before joining UOB Malaysia, Julia has covered Malaysia and regional economies at an ASEAN investment bank, where she has contributed to the research team, winning the top 3 in the country research on Malaysia at the Asian Money Brokers Poll for 7 consecutive years. So without further ado, let me hand over to Julia to begin her presentation. Over to you, Julia.
Thank you, Chenri. Very good morning, everyone. Thank you to Bursa for the invitation, and also thank you to the participants for dialing in today. Okay, quite a lot to get through today, and I thought, given that there's so much uncertainty, and whatever I say now, in a month's time, who knows what could happen, right? So, but I hope that I can give you maybe just an overview of how we see the tariff situation. How, of course, for us in Malaysia, our concerns of how it will come to Asia and even for Malaysia. And then I will end the session with, of course, our thoughts on where Malaysia stands today. Okay, so it's been very rough for equities, and all this is because of concerns of tariff uncertainty, right? You can see from the chart here, there's a gauge on trade uncertainty, and that spiked to an all-time high in February. The on and off again tariff policies have really scared markets. I think this is in contrast to the start of the year when markets were a little bit more, well, I'd say hopeful, because there were initial thoughts that Trump would be more restrained, right? But I think since February, we've seen that he's turned more aggressive, right? And he has reasons to do so, which I will share shortly, right? So also, I think the last few days is that we've seen US data has disappointed. With weaker job creation, the NFP numbers last Friday disappointed. We are actually seeing them less hirings, more firings, right? In the US. Weakness in consumer confidence. I think latest news is some of the US airlines and even retailers have actually slashed their financial guidance, and they have actually highlighted changes in consumer spending and behavior, right? We are also seeing of course, the latest Fed Reserve Bank of Atlanta, their estimates of the GDP now forecast GDP for first quarter, and that's showing a contraction of 2.4% for the first quarter, right? So remember, 2 quarters of contractions would signal a recession. Okay, now of course, coupled with the worry that tariffs could spike inflation in the US, so that's also raised fears of stagflation over there. Okay, so I think overall, these are genuine concerns, and even the former U.S. Treasury Secretary Lawrence Summers has actually said that U.S. is actually, there's a 50-50 chance that they will go into a recession this year. Of course, Trump has played down these recession fears, but he did say that the U.S. economy will go through a transition period as tariffs take effect, right? So I think the main concern is that, yes, we hear, the general view, broadly consensus, is that Trump's policies are inflationary, right? Of course, he's saying that, with tax cuts coming, that will actually help to spur the economy. Whatever revenue they get from the tariffs will actually help also to spur spending and in fact help to redirect a lot more investments back to the US. Okay, of course, immigration policies would affect the labor supply in the US and of course wage growth, right? But of course, where Trump is coming from is that it will actually help eradicate crime, right? Now on US Fed policy, I think the initial thoughts is that the US Fed, may actually keep interest rates higher for longer. But I think in recent days when fears of US recessions have set in, I think markets are now pricing in more rate cuts from the Fed. And of course, Trump has hinted that he would prefer that the Fed cut interest rates, right? Then of course we know green policies. Trump is not a fan of that. And of course, what we're also watching is on the foreign policy part, right? So all these policies, I'd say, very mixed. And it hasn't been easy to assess the extent of this impact, not just on the US economy, but also on the rest of the world, right? There are many moving parts. And I think the biggest risk is that there is a miscalculation of the impact of any one of these policies and how it could in fact affect the US growth, US inflation, and US interest rates. And that will definitely have spillovers to all the financial markets, even for us as well in Malaysia. Okay, so risk number one, miscalculation of Trump's policy, the effect of Trump's policies. Okay, right. Then, of course, let's center the tariff. Tariff is, of course, the centerpiece of his policies. And so far, these are the tariffs announced to date. I think, of course, overnight, again, a whipsaw, back and forth. He actually hit out at Canada, wanting to up the tariffs on steel and aluminum from Canada to 50% because of Ontario imposing 25% slap on the electricity tariffs. But then after that, he's backtracked. So all this backtracking, as I said, is definitely not good for markets. And markets are confused about what is the way to go, right? I think in short, we do expect an escalation in tariffs in the second quarter, right? The key date to watch is the 2nd of April. That's when the country by country investigations are supposed to be completed, and that's when Trump is supposed to announce a range of reciprocal tariffs. Right. Now, if you look on the right side, I think he's also said it's not just about tariffs. It's also about anything that your country imposes that could hinder US companies doing business abroad. So it can even be VAT, taxes, consumer taxes, digital taxes, any such policies that actually it goes against US trade and investments in your country. So it can be any of that comes out of the country of the country investigations. They can use it to slap tariffs on you, right? So I think broadly, if you talk about the impact, it is negative, especially for countries that are export driven, like Malaysia, right? Higher tariffs, taxes, trade retaliation is never good for trading countries, right? But again, I suppose for yourselves, your companies, your area, your sectors, I guess no one story tells it all. And I think some companies obviously may benefit if they are selling certain commodities. And if, let's say, there's an increase in the prices of these commodities, whether it's copper and aluminum and so forth, then of course, that could be good for your selling price, right? But I think some of the recent surveys done is that I think what companies in Malaysia fear most is disruption to supply chains. And I think obviously that is very real, right? Now, while we can hope some of these tariffs can be negotiated away, right? But I think a large part of these tariffs are structural. And when I say that, it means that there are genuine reasons that Trump will do it and has to do it, right? Basically to expand the US revenue because he needs to offset the tax cuts there, right? And he's also to getting companies to invest in the US and of course rebuild the structure and infrastructure, the investment infrastructure in the US. So these are genuine structural reasons where, even for whatever reason that markets are not taking it well in the short term, but these are medium long-term reasons why he wants to do it. So as I this, which is why we said that we have to be prepared that there will be more tariffs coming, right? Now, of course, the other risk is that we also noted there are some signs of retaliation. Okay, if you look at some of these measures, China has come back with with another 10 to 15% tariff on certain goods from the US. Canada has also hit out, right? And on top of that, China and Canada are also hitting out with their own tariffs on each other, right? So all this are some signs that there is an escalation, right, of trade tensions, right? But I would say at this point, the countries, although they have retaliated, they are still providing room for negotiations, right? So that's certainly good, okay? I think the risk is you have to start watching is whether what are the kind of tariffs that they impose on what kind of goods, especially when they go back more structural and they are more hard hitting, right? Then that's when I think you can assess whether the escalation has become more significant and riskier, right? But for now, I think what we are seeing is that there is still room for negotiations. And even as far as Canada and Mexico are concerned, I think they are working towards a renewal of their USMCA trade agreement. Okay. Now, for ASEAN countries, we think less likely to retaliate. Okay, once Trump announces the tariffs, I think mainly because I think our countries are seen to have less leverage, right, and more likely to take actions to appease Trump. Okay. But of course, another area that of concern is, of course, provision of military aid to the region. Okay, but as I said earlier, what some of the surveys shown is that the businesses are concerned is that supply chain disruptions, and of course, concerns about dumping of cheaper China goods in Malaysia, okay, or even China stopping sales of certain critical minerals to foreign parties, right? Not just US, but across the board, right? Especially critical minerals. So these are also some of the other risk areas to watch. Okay. Now, so one concern is who is the next target. Okay, and based on the main US trade partners, what we can see is that obviously he started off hitting with his neighboring countries, Canada, Mexico, and then of course the biggest another target is China, right? And I think of course the next one that everyone's watching is, or Trump has already said, is EU. And then if you look at it at who is next is of course ASEAN, right? And ASEAN more so because if you can see in terms of the share of imports, the share of imports from China dropped since 2015, but the share of imports from ASEAN has risen. So again, there is evidence that of diversification and movement of some of those flows to ASEAN, from China through ASEAN to the US, right? So certainly, I think we are definitely on the radar. Okay, now who in Asia or ASEAN could be next? I think if you look at the countries at risk based on their trade balances with the US, okay, say Vietnam, Taiwan, Korea, India, Thailand, they all face higher tariff risk. Okay, Malaysia is also there because we do have a trade surplus with the US, and so far in terms of the actual the tariffs on specific goods like iron, steel, aluminium, the percentage on or share of Malaysia's exports of these items to the US is small. Okay, so not that significant, 0.2%, right? But I think the worry for us more is on the immediate risk is the tariffs on semiconductors, because based on US imports, Malaysia is the third largest exporter of electrical, electronic, semiconductor equipment to the US within Asia. We are the third largest after China and Taiwan. So I think obviously this is probably the most immediate risk for us. And so far, in terms of measures, like you can see a lot of countries, they have started to negotiate with the US or speak to the US. I think within this region, Vietnam so far has seemed to be the most proactive. And they have been negotiating, they've been talking to US officials, and it looks like they have a plan. Okay. I think Thailand is concerned, but probably not as, doesn't seem as to be as proactive as Vietnam. And for Malaysia, I think we are taking a wait and see approach. And Tunku Zafrul is going to US. I think he mentioned that they are going in May to speak to the officials there, right? And I think yesterday it was also announced that Prime Minister has invited Trump for the ASEAN summit later this year. Okay. Now, another theme of Trump's reciprocal tariffs is tariff gap. So meaning, what is the difference between the tariffs we impose on imported US goods versus their tariffs they impose on our goods when they go there, right? Now, for Malaysia, the tariff gap is actually quite small, 5.5% on their goods versus 3.2% on our goods in the US, okay? Now, so this seems like we are not really, we are sort of lower on the pecking order compared to the other countries. But now we deep dive into 5,000 products and we found that there are large tariff gaps for a range of items from food, agriculture, consumer, industrial, and manufactured items, okay? Meaning that these are the tariffs in pink, in red, that we impose on US imports, versus in green, the ones that that the US imposes on Malaysia goods, right? So you can see that actually there are wide tariff gaps on some of these goods, and these tariff gaps may actually materialize and actually become the point of contention, when next month when Trump announces the reciprocal tariffs. Okay, now, also, if we look at, of course, to be optimistic, there are some silver linings like trade and supply chain diversification, right? Now, but in the near term, due to the tariff uncertainties, I think we expect generally higher downside risks. And since Trump 1.0, we did see evidence of trade rerouting, which benefited Vietnam, Thailand, and Malaysia. But you can see that that also makes us more vulnerable this time around under Trump 2.0 to an external slowdown based on our trade dependencies, right? But overall, in the medium term, I said on the optimistic side, we do still continue to expect supply chain diversification, market diversification, especially as countries try and negotiate on more trade agreements, regional integration, and diversification, right? We project a continued rise in ASEAN FDI, ASEAN trade flows, right? But we are also mindful of the risk, right? Especially if there could be new or larger tariffs coming our way. Some countries in the region that could be targeted by the US. Or I think the most severe is that if there are higher recession risks in any of our key trade partners, particularly US, China, or even EU for that matter, and that could trigger, of course, a global recession. Not our base case, but definitely I think this would be the worst case by far. Okay, so coming to Malaysia, I suppose just to size up, right, some of the risk channels for Malaysia. It's again very hard to put a number on any of these, but I think just very broadly, there are really three key main risk channels for Malaysia, right? The first is, of course, the direct tariffs on Malaysia, right? That can be through 10% universal tariff, a tariff on specific products. As I said earlier, the most immediate risk is semiconductors for us. Okay, now if they hit out at countries with a higher trade surplus, so we are also there. If there is a tariff gap with the US, we also have a tariff gap. So certainly this would be one of the key risk channels. Now, the other risk channels is if there is a spillover, negative spillover from tariffs on our major trade partners. I think in this case, particularly on China, right? How it will affect the China growth, China demand, and China supply. Because if they don't sell as much to the US, they will need to seek markets for their excess production, right? Now, and of course, the third one, escalation into a trade war. That would be the biggest worst case risk scenario, right? And I think this one is, we just have to monitor if there's an escalation of retaliation from the other countries. Like as I said, so far nobody wants a trade war. And although there are some retaliations, but it is not to the extent, it always allows some scope for negotiation. So we are still seeing that. So that's good news. But again, this is something that warrants watching. And as I said, if there is some miscalculation, and I think the biggest risk is egos in our leaders, right? And particularly in the US leader, right? That could actually give way to this trade war risk, right? So I suppose that all this will have to be wait and see and watch where this goes. Okay. Now, the other, of course, concern is on the data center issue, right? I think after US announced the export controls on US AI, access to US AI chips and technology for certain tiers of countries, I think there are concerns for where Malaysia could stand on this, right? So I suppose just to wrap it up, these are some of the key risk channels that we will need to watch for. Not our base case at this moment, but we have imputed some extent of the universal tariffs and also the tariffs on our major trade partners, but we have not imputed an escalation in a trade war at this juncture. Okay, right. Now, the other risk, of course, aside from the tariff trade risk, is forex volatility, which I'm sure your companies, investors are concerned about. So far, what we have seen is that the Asian FX has been holding up better than expected in the first quarter, despite the tariff risks. But that could also be because we don't know what the tariffs are going to be like yet, and that will come in the second quarter, right? So I'd say not to be too complacent just yet. Okay, there are still potential weakness for the Asia FX, right? But so far, I think what we have seen is that the dollar has pulled back on US recession worries, also increased expectations for more US rate cuts, right? I think ringgit has also been propped up by a more stable CNY daily fixing, right? And of course, not to mention also is the peace dividends from the US from the Russia-Ukraine, ceasefire negotiations, right? So I think this peace dividends has actually propped up the euro. The euro has actually has seen very strong gains and probably at its highest level in 4 months, right? So I think that has certainly helped. Even the Japanese yen is at the 5-month high, mainly because on expectations of Bank of Japan expected to hike interest rates a few more times this year, and also because Japanese yen is seen as an Asian risk haven. Sorry, as a as a as a as a safe currency to hold during higher risk aversion, right? But coming back to the ringgit and as you can see from the chart, very very strong correlations between the ringgit and the CNY. So I guess for us, we also have to watch where China's economy goes, how the tariffs will impact China, and also where the dollar CNY is, right? As I said, so far it's been stable, which is given ringgit that underlying stability as well in the first quarter so far. Okay. Also, dollar ringgit has been trading in quite although yes, it is volatile, but it's been trading within a certain band. And we can see that I think since September last year, right, ringgit has been a lot more resilient despite periods where CNY has been prone to more weakness. Okay, and why is that? Okay, so I think this is also an interesting story to tell. Mainly because I think firstly, since last year, I mean, Malaysia's macro story has turned more positive, right? The investment story has been good. We have seen inflows of FDIs. Our ministers have gone on road shows, road trips to sell the Malaysian story, and it is backed by fundamentals, right? So that's positive. The other thing also is that I think the stance of the government on the ringgit has somewhat changed, right? In the past, ringgit, when it weakens, they always say it's good for exports. But I think at this point in time where Malaysia, we are trying to move up the value added chain. We have all these national master plans, which are dependent on technology investments, which some of it we don't have. Okay, so to bring in this technology, these investments, actually, you can't have a weak ringgit. Okay, so I think the stance on ringgit has changed, and they also know that it also reflects the domestic sentiment on the country, right? So I think preventing a misalignment of the ringgit is very important. And we have seen since last year, during that time when ringgit was at risk of breaching 480, we have seen actually Bank Negara working with the GLCs, the GLICs, MNCs, corporates, exporters, to try and get them to repatriate and convert to the ringgit, to shore up the ringgit confidence and stability. Okay, the Bank Negara also have this qualified resident investor program that's supposed to provide flexibility for local corporates or even MNCs who repatriate and convert some of the foreign funds into ringgit, right? So if they want to repatriate and send it out again, the approval from Bank Negara will be very swift. So all this is done to ensure more two-way flows, right? So I think all these measures have worked well so far. And as you can see from this chart, the black line is actually a ringgit. It's indexed and normalized. And you can see that since last year, it's actually despite it's come off, but it's still showing resilience. And you just need to monitor where the ringgit is against some of our the other currencies like the Sing dollar, the Aussie. It's still showing that it's not as weak as it was in past years. Okay, right. So in a nutshell, so we talked about where the tariffs stand. And so far, watch for 2nd of April. We are expecting more tariffs to come in the second quarter. Okay, we will need to see how the Fed assesses the impact of Trump's policies on the US economy, on inflation, and where they could go on US interest rates, right? I think watching for escalations of trade tensions, okay, because this is, after all, the biggest risk for economies, especially trading nations like us, okay. Energy transition, I think despite Trump backing out, I think we still expect countries in Asia to remain committed to net zero goals for now. All right. Okay, let me just do a time check. Okay, I have a little bit more time. So let me just quickly go through the Malaysia part of this. And then before we, if we see we have any time for any questions. Okay, so for Malaysia, I think for now, it's really all external risk, right? We are still keeping to our base case forecast of GDP growth of 4.7% for this year, right? I think we are seeing there's still many domestic levers that can cushion Malaysia's growth outlook, right? As I've highlighted here, especially the domestic growth engines, consumption and investment, several factors: wage growth, cash assistance, 13 billion ringgit, EPF withdrawals to support spending, demographics is still, yes, we are eventually approach aging nation, but we are still generally at this point, working population so far we are still in a sweet spot. Household asset growth last year, actually first half was actually very strong, over 8%. I think thanks to also the equity performance, and of course we also had a very strong distribution of dividends from EPF, right? The property market, actually Malaysia has a good 2 years in the property market growth, especially down south, Johor, right? Capital markets, private equity, wealth, and then of course on the FDI side, we're seeing strong investment approvals coming in, and more coming in from the domestic side as well. All help also with, of course, the execution of the master plans and the policies, right? It's policies especially to improve domestic supply chain resilience, right? Government will be introducing a new investment incentive scorecard in the second quarter, right? So all this is supposed to it's all about targeted focus areas where the government wants to target in terms of where they want to see investment growth, higher value added areas, the latest national semiconductor strategy, and the tie-up with a foreign partner, right, to increase R&D research in semiconductor design. So all this, I'd say, when you look at it, the policies are there. It's positive, it's supportive, right? So I'd say these are some of the domestic levers that will help Malaysia, I think, over the next few years. Okay. Now, having said that, I think on the consumption side, yes, it is a positive, it's a robust growth story. But having said that, if you look at it, compared to pre-pandemic, right? Actually, normalized consumption growth is not quite back to where it was in terms of the growth level and also in terms of the contribution to GDP growth. Okay, why is that? What are some of the reasons? I say the cost of living issue is certainly there. Inflation aspect, we've seen inflation rising. I mean, it's still, of course, at less than 2%, it is very muted, right? The headline inflation number. But of course, when we go down to the ground, you can see that certainly in certain aspects, the cost of living has gone up. Budgets are tighter. And so even consumption spending patterns, I would think, have shifted, right? We saw post-pandemic shifting from goods to services, but I think increasingly when higher costs bites, I mean, it will definitely be more on value-based trades, right? Where they can get the best value from. And I think certainly something that we will need to watch for, especially in the second half after the government rationalizes petrol subsidies. Okay. Right. Now, on top of that, also, of course, a host of government reforms that will be coming in, you know, whether it's minimum wage, it's the expansion of the SST, then there's also the e-invoicing that will be introduced nationwide come July. And I think the Parliament just passed the EPF contribution for foreign workers that will be implemented in the fourth quarter of this year. So a host of definitely reforms which are necessary, I would say. Yes, not great for consumers, businesses in the interim. There will be a period of adjustment, but I think as far as structural fiscal is concerned, some of these reforms are certainly necessary. Okay, to ensure, I suppose, the sustainability of the government's fiscal position, and also to ensure that we have the resilience to face whether it's a next crisis or recession. Right. Okay, so that concludes my presentation. This is just to summarize some of our key forecasts for this year for Malaysia. As I said, GDP 4.7% base case, right? Inflation 2.3%, but this does not impute the RON95 subsidy rationalization. So far, what we've seen is that the government forecast is is that it could go to as high as 3.5% headline inflation, even after imputing some of the increases in the removal of the RON95 subsidies. Okay, for now we're expecting OPR to stay at 3%. I think on this note is that at this point, given that external risks are there, the tariff uncertainty is high, and given that some of our export products could be significantly affected as a result of this of some of these changes, right? So I'd say there's more downside risk than upside risk at this point. Okay. Finally, dollar ringgit, we are looking at 455, and by the end of the year, we think that we are still holding to our view. Perhaps we have to be prepared for another 1 to 2 quarters of weakness for the ringgit, depending on where how the tariffs pan out in the next few quarters. Okay. As far as US is concerned, we are only projecting 1 rate cut now, although I think we are mindful that in the last few days, since the US recession fears have set in, I think markets are pricing in more, I think up to 3 rate cuts this year for the US. Okay. All right, I'll pause here and I'll pass it back to the moderator. Thank you.
Hi, thank you, Julia, for the insightful presentation. So we are now open for Q&A. Please type your questions in the Q&A section. So maybe I will start the ball rolling. So this year, Malaysia will be chairing the ASEAN. So what do you think that Malaysia can do to band together the ASEAN countries to amid this trade war? How can they work together to overcome these challenges?
I think on the defense, obviously, is that we have to come together and negotiate find areas where areas of leverage are quite tough because, as I said, ASEAN overall, we may not have that much leverage, except for the fact that we are very plugged into the supply chain and US dependencies, US companies dependent on the ASEAN supply chain, right? So we have that for us. But again, like it really depends how Trump sees it. And as I said, Trump has very structural reasons why he still has to do the tariffs. So we have to be prepared that there will be higher tariffs, right? It's just the extent of it and whether there are any carve-outs. So far, Trump has shown that he's not that agreeable to carve-outs. Even initially he says so, but then after that he reverts back. For instance, Australia tried to negotiate away the tariffs on steel, aluminium. That didn't work. And even for Japan, they are one of their biggest allies. US has not given them any assurance as well, right? So I think what's more for ASEAN. But definitely we still have to come together to negotiate, find ways. And I think on the other side of it is also continue to diversify, seek ways to expand our markets, which is what we are doing. Regional integration, that's also been widely talked about, how we can leverage off more on intra-regional investments, consumption, and cooperations, right? For instance, like what we are doing down south with the JSSEZ with Singapore.
Okay, thank you. There's a request to look at slide 11 again.
Slide
Can we have a look?
11.
Yeah, thanks.
Okay. Oops. Is it this one?
In the one before, previous 11?
Before?
Yeah.
Sorry.
I think
Yeah,
this one,
because some
yeah.
of my slides and numbering is there's 10, there's 12. If you can say which slide is it that which topic is it that they would like to look at?
I'm not sure. The request
Or
here
there's a
says
specific
slide 11.
question. Okay, there's a specific
I
question.
think we'll leave it here and move on to the next question. So earlier you mentioned that the semiconductor industry is at risk. So any potential sectors or industry that could benefit from, say, trade rerouting?
Trade rerouting. I mean, typically, what we've seen is that I think when you look at the share of you look at the percentage share of imports and exports, the changes, right? I think the most obvious and significant is the E&E space. Since the last few years, and even when we see that the share of our exports to the US of E&E related equipment, also it's increased significantly over the years. I think that's again the sign of potentially trade diversion and supply chain shifts, right? So but as I said, this time around, Trump 2.0 is a little bit different. I mean, there again, medium term structurally, for sure, with all these kind of risk, the view is that that even though cost is higher, right, it's not so productive, but simply because I'm not sure if you've heard, rather than just in time, it's now about just in case. That's why companies are looking for alternative markets and that +1 strategy, right? It used to be China +1. Now it can be Vietnam +1, Taiwan +1, right? And Malaysia would be able to benefit from that, right? And we can see from Malaysia's investment approval numbers and even the trade numbers, we have seen that more diverse. In the past, the main countries that come to Malaysia are always US, China, right? But increasingly, we also seeing like Taiwan, Korea, EU for that matter, also coming in. And even our trade partners, you can see the shares of our trade going to certain countries have also been rising. So again, another sign of evidence of trade diversification. So I'd say certainly we will be able to benefit. In the past, the most obvious area that benefited was E&E, but like I said, like we really don't know under Trump 2.0 where he will hit at, and he has shown a tendency that he will just hit out at anything or everything depending on his whim and fancy, right? I've also heard this quite scary, but one of the observers, foreign observers, actually said that Trump, you know how we always say he's transactionary, so that's good for markets. But with countries that don't have much leverage, right? So I've mentioned some of the countries, that the smaller countries, right? For us, we don't have much leverage. He has a tendency to be predatory. So rather than being transactionary, it's predatory. So that's quite scary, right? So I think what's important is that we really have to try and engage the officials and hopefully find a workaround. But at the end of the day, I think we, as for Malaysia, we have to be prepared that if the tariffs do come in, how do we absorb the tariffs? How do we work around it? And what concessions can be given?
Okay, thank you. So we have two questions on the CHIPS Act. What is the impact on the data centers in Malaysia, and can we renegotiate to move out of the tier 2 status?
Um, even some of their biggest allies are in tier 2. So I was just thinking, quite tough. I suspect any country that they suspect could be, I said lah, be used to evade or so-called avert the US tariffs on China, I think will be parked under tier 2, simply because of that, right? I think even and so I think quite difficult. The caveat, the carve-outs are if you, of course, you are a US company, for instance, the big ones like Microsoft, Google, they are here. Maybe they have their own arrangements where they are already following the US, so-called their rules and their regulations and so forth. So maybe they have no limitations, right? But I mean, I will share is that increasingly data centers, what people are looking at is more who are your customers rather than um, I'd say more who are your customers, because at the end of the day, US will also probably look when they are supplying chips and these AI, all these technologies, right? If one of your key if your key customer is a China-based, Taiwan-based, right, then obviously more hesitant to supply more to you, right? So it's all about who you are selling to at the end of the day. Yeah.
So there's a question uh, from as an exporter company with high percentage of client in the US, should this company focus more in ASEAN or local business?
That certainly diversification is good. The problem is that at the end of the day, ASEAN still sells more. You have to look at who the end market is, and the end market at the moment is still, for E&E related, is still US or China, right? And EU. I'm not sure if you've heard of this term bifurcation. Okay. Basically, it's a split of supply chains. I think we've heard about this years back, even during Trump 1.0, and we felt that simply because these geopolitical trade tensions and all, they have very strategic reasons. I mean, simply because China wants to maintain their dominance in this area, right? And to do that, they have to ensure that certain parts of the technology they it's not accessible for the Chinese counterparts, right? The Chinese players. So the explanation is that this will create two supply chains, one that is more aligned with the US and one that's more aligned to China. The issue is that if you are on both markets, we are naturally a neutral party, so we will want to sell to both sides. But it comes to a point where, for instance, like in this AI space, they can tell you, NVIDIA can say, if because you are selling to a Chinese related party partner, we can't supply you anymore, or even supply at all, right? These are the kind of very practical things that and risks that we can see potentially coming simply because of this tech race between the two giants, and obviously, US get very, very serious that they want to maintain their dominance on this, right? So I think where, of course, opportunities are, I mean, I've heard some Japanese companies saying that, oh, we are going to create divisions within our company, one that's more to supply US, one supply to China. But practically, whether eventually based on where US is heading and going with their export controls and rules, whether that is actually feasible, right? I think that's the biggest question and concern that obviously for neutral parties like us that we have. Okay, but certainly I think the rule is to diversify, to look at your customers so that you make sure that if overnight you suddenly lose the orders there, of course you have some another plan or something to fall back on. But looking at the way things are going, of course we don't know what will happen in the next 4 years or whether Trump loses. But so far you can see that in US Congress, it is bipartisan. This seeing China as a challenge and a competitor, and them wanting to maintain their US dominance in areas like military technology is very real. So I'd say have to really relook at your customer base, your markets, to be prepared for anything that comes. Yeah.
So eventually we have to choose sides, is it?
We hope we don't,
Yeah.
but I can share with you that 2-3 years ago, the IMF actually did a study. Of course, you can say IMF is also a bit biased, but they actually did a study. They said that obviously this is hypothetical, but they actually grouped two countries. They grouped countries into two sets. One that is allied to US, one that's allied to China. Naturally, all our countries in Asia are all parked in the allied to China group simply because of the economic linkages, right? But the conclusion of that paper at the end was losers are neutral parties. Very interesting. Losers are neutral parties because you will be forced to align to one side. Okay, again, not my. This is something that came of a IMF study, and I thought that was quite interesting. So I'm not sure whether it was a message that they wanted to send that at some point in certain, I think not all, I mean certain low medium value goods, that's not the case lah. But I think when you're in an area where you will know lah, high value and anything that related to high-end tech, advanced semiconductor manufacturing, all these kind of areas, yeah, then there is a risk lah. Yeah.
So just to add on this, there's a question on BRICS. So will it be better to negotiate through BRICS, or will it be worse off through BRICS?
I think it's necessary to negotiate, because if we go by the playbook that we need to diversify, we need to seek cooperations. I think we need to, especially for small countries, right? Because at the end of the day, and some more if you are BRICS are very much resource-based countries, right? Oil and gas, so forth. And we are an exporter of oil and gas, right? So I think it's important that we have a seat at the table during discussions, whether we actually whether it really makes a difference, but just being able to have a seat there to be part of the discussions, I think is important. Of course, I think the risk is that, yes, Trump has said he would hit out at all the BRICS countries if they decide to move away from settlement in US dollars. Okay. That I think even without BRICS, I think already within ASEAN over the years, they have been encouraging countries to do settlements in local currencies anyway, not simply because they don't like the dollar, but it's because it's so volatile, and it's easy, and it's much easier, in fact better for some companies if they just do it in local currencies, so that they take away that volatility and the potential for losses in their results and their balance sheets, right? But I think the short of it, I would say, is still necessary. I think just simply to, especially for smaller countries, to be part of those discussions.
The next question is on Trump calling the US companies to reshore back to the US. So what is the progress of this reshoring back to the US? And has it been affecting the US dollar?
We have seen some. I think there's some companies that have already announced that they will, one Taiwanese company and one, I think some Japanese also, they are actually announced that they will actually onshore some of the investments. Okay. Whether it's affected the US dollar, I think so far the dollar is, as I said, like it started the year stronger, but now with with worries of US recessions, we've seen some of that strength pulling back. I think at the end, what's driving the dollar is interest rate differentials. So I said, like, if the expectation is that US is going to cut rates more, that narrows the interest rate gap, then actually that is not good for the dollar, right? But of course, behind the story is also that whether US can actually, I said lah, bring back whole lot more types of investments, and especially after they do the tax cuts, the corporate tax cuts. I said lah, all these policies are in the plans. I think the problem is that the details are not out yet, right? So it's really hard to say for sure. But at this point, what we think is that our house view is that we may have to see, for Asian currencies, we could be susceptible to weakness in the next 1-2 quarters, especially after I said like they're moving from Canada, Mexico, China, EU, and then will be ASEAN. So we have to wait for when he announces the tariffs on ASEAN. Then that, I think that period you could see a lot more volatility and potentially more bias towards weakness for Asian FX. Yeah.
So what is your view on the Johor Singapore Special Economic Zone?
We are positive, like every other bank, I think. I mean, but there are genuine reasons. We always knew that there is strategic opportunities and for cooperations, but it has to be done from a G to G level. And we have seen that happen, right? With the signing of the official agreement, the leaders meeting. Now it's about, and they've also announced some incentives. And I have to say the incentives, yes, some people said that, oh, of course, compared to the past, not as great, not as attractive. But I think you also have to bear in mind that these incentives are tailored to be aligned with our national master plans, where they are focused on certain areas, certain segments, certain types of industries. Like I said, moving up the value chain and ensuring that there's a positive spillover to the domestic economy. I think those two things are very key, because that's the only way to ensure that we will see the benefits of it, and of course the medium-term potential to lift the potential growth of the country and the economy. Right. So on that note, the way the incentives are being done, are strategized, I think it's quite commendable, right? Of course, it has to, with time, we have to see with time how this progresses, and of course the incentives announcements are going to be refined along the way. So it's not like you're going to see the benefits and the advantages immediately. It will be over a prolonged period. But I have to say that with all these trade tensions, uncertainties and all, and as I said, as you can see from this slide, is that we do think that the silver lining of that diversification will still happen. Of course, a bit of bumps along the way until we see more clarity on the tariffs, and how Trump treats ASEAN, right? But in the medium term phase, we think that it will still benefit ASEAN, and for Johor, Singapore, they are very strategic positives working together. And I think that is really like a gem for this region, because we are showing the rest of the region that if we can make this work, then it could be a playbook for a lot of other economic zones in the rest of ASEAN.
Yeah, what are your thoughts on the prospects for the glove industry? We have seen the China gloves being hit by tariffs. So will our glove benefit from this?
I just disclaimer, I don't cover the sector. We don't have a call on gloves. Yeah. So like I said, it's we just have to wait and see whether he has a specific tariff. I doubt so much on gloves, because I mean, gloves, it's you think of gloves, it's just like in the park, you park it with medical supplies, right? During the pandemic, everyone was scared. Any supplies of these kind of items, right, are necessary, right? So it wouldn't be it doesn't sound like it, like doesn't make sense, but again, you never know. You never know. So I'd say anything and everything is possible at this point. Yeah.
So, in your view, what is the difference between Trump 1.0 and Trump 2.0? What has he done differently this time around?
Okay. Good question. Because that's how I mean, now like I said, like we are still trying to guess how he will react. Okay. And I think the key differences are that he is, because he's, I think, 76 years old. This is possibly his last term already, age-wise, like if you think about it, right? Just like Biden, right? Past 80 already, quite difficult. So when on that note, what I've read is that he wants to do this. He wants to get through certain things, which, yes, it will be painful to the US economy in the short term, but he feels that it will be good for the country in the medium long term, you know. And I think they really do see that US has lost out in a lot of areas. And as I said, they want to maintain their dominance in certain areas, specifically advanced tech, that links to military. Um, and 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 in order to do that, right, they have to go through the tariff route, right, rather than incentives. Biden's way was the Chip Act, play nice, incentivize for companies to go back to the US. But this time now it's like, no, it's tariff would be, maybe to him, is the more effective way to go, right? So we see, I do, what I see is that he is more they really want to get this done. Um, and hence, and they are more prepared as well, because in Trump 1.0, it took them 1 year before the tariffs came in. This time round, within a matter of, in fact, months, he's already announced it. So it shows that they are serious about it, right? The other part that's different is that he's not hit out at other countries. First round, he only hit out at China, right? I mean, like, as in China was the main target. But now, because after a few years, they know that there's been, I said lah, flows trying to evade the tariffs via other countries. So what they're saying is that we will hit out at everyone. That would be the easiest way lah for them, right? So that's why it's different. And I'd say the stakes are higher for a potential miscalculation of any of the impact of these policies, right? And I think that's the part where we really have to watch.
Okay, maybe just one last question. So, on the US economy, what would be the net impact that you expect? Will it be a budget deficit or surplus debt from the tariffs, the tax cuts, the government job cuts? In your opinion, what would be the net impact?
I think it'll still be a deficit. In fact, we saw during Trump 1.0, even after all the tariffs on China, the deficit actually widened, right?
Oh, okay.
Yeah, simply because there are a lot of things that the US doesn't produce. They still depend on others. And why is that? Because not so productive. I mean, especially for low value items, it's just not productive to produce there and sell there, right? So that's why I think the deficits would still be there, but what they are trying to do is to control it. And I think if you ask me, the deficits would be best controlled by what they are doing now in terms of improving government efficiency. Yeah, that may be better managed. But I think in terms of trade, US dependence on imports will still be there, which is why it's a very tough call with them doing these tariffs, because they said like the view is that if you are so dependent on imports, it would certainly be inflationary. But what Trump is hoping that is done to minimize the impact on US consumers is he wants other players, other countries to reduce their prices, right? That way, the final price on the US consumer will not be as big as the so-called 25% tariff tax, right? So that's what I think they are hoping. But again, as I said, this part will really depend on negotiations, depend on your supply chains, to what extent consumers and businesses, exporters are willing to absorb that cost. Can they, and will they? Yeah.
So we have reached the end of the webinar. So thank you, Julia, for sharing a very insightful presentation and your views. And thank you for all the guests who have joined. And if you are fasting, selamat berpuasa. So see you at our next webinar. Thank you.
Thank you.
Thanks, Julia.
Right. Thank you so much, Julia.
Thank you.
Thank you. Thank you for taking your time and also your commitment for this. So hopefully everything went well. Hopefully we can collaborate further lah for the next engagement, perhaps.
Okay, sure.
Thank you so much again.
Hey, thanks
Thanks so
again.
much.
Okay, thank you so much.
All
Yeah,
right.
I'll end the webinar now. All right.